Ron G, the Net Worth Nation, coming to you tonight to simplify, I hope, the FRS retirement system. Like many of you who I've had the pleasure of meeting out in the district, we've always seems to come back to those types of questions. So I hope tonight I can clarify a little bit about what the FRS system's goals are to accomplish and how we at Net Worth Nation work with you to maybe overcome some of the potential obstacles that are out there to face. Now, without further ado, we need to get into tonight's material so we can kind of see exactly how all this plays out in your grand scheme of your retirement product. So without further ado, let's go and dive into the material. Here we go. So the Florida State Retirement System, for the record, let's just say that those of you out there who still get pensions, kudos, kudos, kudos to you, because it's not everyone there that does. So the fact that the state has taken the consideration to ensure you guys have a pension is a very, very, very good thing. So I do want to start out by saying that. But the question of the day is, why may your pension not be enough? That seems to be where we are now. Because again, we understand that the pensions are things that, how can we say, well, let's just say the state of Florida has been in a little bit of trouble with keeping up with the cost of providing for the pension. And so there was a few things that they recognized that they had to do. The first thing they wanted to do, and again, before we get into that, is making sure that you know what your numbers are. But the first thing they wanted to do was to make sure that this pension was able to survive the various types of calamities and different things that happen in the state of Florida. Let's be realistic. We're all coming through some of the tough road here with the hurricanes that just hit us the last couple of weeks. Helene, and we can go on and on about the dangers of being in the state of Florida, and also some of the problems that some of the insurance companies have had in this state. So we know that we're dealing with a lot of those types of things as well. Now, again, how do we calculate the pension? Again, calculating a Florida state pension is going to depend on a couple of different factors. The most important things that you want to remember is, when did you enroll? How long have you been in there? And what are your plans? You're going to ride it out to the end. Do you plan on maybe leaving the district and working for another employer? These are the types of things that all go into it as well. Now, as I mentioned a few minutes ago, there were a few things that were adjusted. Florida, keeping in mind some of the things that was going on in the state, and they came up with two types of retirement plans to kind of offset some of the things that were happening. One, again, was the basic pension plan, and the other one was the investment plan. So again, with the pension plan, the investment plan, these are some of the things that were done. Again, the annual pension benefit, there is a formula to determine that. So for those of you, who are listening tonight, it is the same formula consistent throughout the state. The average final compensation times the number of credible years of service. And then, of course, you will have a specific pension formula that's based on the craft that you worked at. That average final compensation, or the AFC, takes into account 2 years. One is the 5 highest earning years, or the 8 highest earning years. The 5, of course, for those employees hired before July 1 of 2011, 8 years for those who were hired after that date. Again, those are the 2 dates that you're gonna keep in mind throughout the entirety of this particular video. Years of credible service is going to be the total years that you worked under the FRS pension plan. So some of you guys who left, maybe work for other employers, we will break it down when we get to the Social Security calculations. But for now, the pension calculation is based exclusively on your years under the pension. Now, we mentioned employee classification. This is an important number, 1.6 for standard. Special risk classification are your law enforcement officials. They're given a little bit higher margin there, 3%. Again, your senior managers at 2%. And of course, elected officials that work under the state, 3%. So again, these are the formulas that are going to be utilized when they're calculating your pension. You'll see where that comes into effect in a couple of minutes. So again, we talked about the highest earning years, keeping in mind that 5-year period, and of course that 8-year period, the sum of those years, and then we're gonna do the division and the multiplication. So for the sake of this example, let's just use $50,000 a year as an average salary for a lifetime income in the FRS system. This person did 25 years of service. And so because of the classification of this particular employee, standard employee, meaning like a teacher, custodian, bus driver, jobs of that nature, 1.6%. So they multiplied it 50,000 times the 25 years of service times the percentage multiplier of 1.6%. And as you can see, this person's salary is now and it's going to be $20,000 in retirement. So just take that in consideration, guys, because you're averaged around 50 grand a year. And so now in retirement, you have to downsize to a $20,000 a year salary. That's $30,000 that you have to make up. So we'll get back to that again in a minute, but just keep that in mind. Write that down on the side. That's $30,000 that you have to make up. Again, we do consider cost of living is considered, but there's that date again, July 1, 2011. If you were vested before July 1, 2011, you may be eligible for a COLA adjustment, which can increase your pension over time. Always pay attention to the may. You may. You may doesn't mean you absolutely will. So you see that little cushion of wordplay, you may be eligible or you may not. So again, you can't necessarily depend on situations like that. Also, the vesting requirement, guys. This is a big question with a lot of my people out there that are talking about, well, what happens, Ron G, if I leave after 5 years or if I don't stay the whole 8 years? Again, this is when you were hired. This is why I said that July 1, 2011 comes back consistently in the conversation, because if you have to wait the 8 years to be vested and you leave prior to those 8 years, you have the potential to lose all of the income that you put in. Now, there are other products that we will talk about briefly. For the sake of this video, we don't have that much time to go into all the details, but there are other things you can do to offset that. Again, your retirement age, how early you come in, how early you go out, all that type of stuff, that also has an effect. So just keep in mind when we talk about the pension, you saw it, a $50,000 a year average is consolidated down into $20,000 of earning power in retirement. So what makes up the natural organic gap? Well, again, for most of you out there, if you do qualify for it, you may be able to pick up some pieces in Social Security. So bottom line, FRS and pension investment plan, because again, we saw that the COLA is a maybe situation. The investment plan could potentially pick up some of the pieces there, because with the investment plan, now your retirement plan is being put into the market. If it's put into the market, there's a potential that the market can elevate. I mean, there's a potential, of course, it can decrease as well, but there's that potential that something may be able to happen there. So as we mentioned earlier with the Social Security may be able to pick up some of the pieces that were lost in that pension drop, in that pension gap, where you see the person went from 50, down to $20,000 on an annual year. But Let's look at the Social Security aspect. It's a little bit different from your pension. They don't look at the 5 or the 8 years. These guys are going to look at the 35-year history of your entire scope of work. So for those of you who may have come from other professions, you would have to look at this from a different set of lenses than maybe those who were spent their entire lifetime under the FRS system. So again, looking at your history, the index your earnings for inflation, your historical earnings, but it's going to look at the top highest average over that 35-year period. For those years that you may or not have worked in that 35-year range, they will just zero you out altogether. Now, don't be intimidated by the zero, because you'll see in a quick second here that the Social Security formula, yeah, let's look at it. So the sum of the highest 35 years is going to multiply those by 12 to get that annual number. And then it's going to break down a formula based on the system called PIA. PIA is the primary insurance amount, monthly amount you will receive, right, if you claim Social Security at your full retirement age. Again, the full retirement age depends on the year you were born. So if you were born before 1960, once again, if you were born before 1960, your retirement year, full retirement benefit will be 35 years of age. If you were born after 1960 and after, then it's going to be 67. So again, we see how the goal is to, yeah, just keep stretching that year out. Who knows? My kids, it might be the age, it might be 70 for all you know. But again, we do understand people are living long, right? So that's the good thing. Now, the SSA applies a progressive formula to your aim with these 3 fixed, they call them BEN points, which is otherwise known as dollar amount. So the first $1,115 of that number is multiplied by 90%. So it's going to take out the first $1,115. It's going to do 90% of that number. And then 32% of the remaining number minus the 1115. And then last but not least, if that number is above $6,700, $6,721 to be exact, you'll take an additional 15%. So you see already from the tonality of what I'm saying, these percentages of mean that these numbers are absolutely being reduced. And as you see in my bullet here, doesn't look like it benefits the high income earner. Let me show you what I mean by that. So case in point, a person who did about $5,000 on average a month, so that's what, 12 times 5, $60,000 a year. The other example was 50 grand a year. This is a person, maybe making 5,000 a month, so that's $60,000. And look what it does. It takes $111 out of the 5 grand, and it takes 90% of that number. Then it comes back and takes 32% of the remaining amount. Okay. And then what happens is they add those 2 numbers together. They add the remainder after the 90% is deducted, and then they add the remainder after the 32% is deducted. That's how you're able to add the 1,350 plus the 1,243.20. This is the remainder of the 90, and this is the remainder of the 32. And the sum of those 2 parts is 2246.70. So that's how a person who average around 60 grand a year over the lifetime of their Social Security working years ends up with 2246. So again, this number is a little different for those of you who may not be paying into Social Security taxes. So all FRS organizations may or may not pay into Social Security taxes. So double check, look down at the bottom of your pay stubs when you get paid your next check, and just double check, make sure you're paying your Social Security taxes. Again, this is depending on full retirement age. Some people delay it so they can get more. Some people take it out early because they say, listen, I don't know how long I'm going to live, Ron G. I want my money now. I'm not going to fuss at either strategy. As long as you have a plan in place, both strategies could potentially work for you. But just you see an example, that one here at the bottom before I jump to the next slide. If your full retirement age is $2,000 and you claim it at 62, you may only receive about $1,400, which is a 30% reduction. So that kind of gives you the idea of what that looks like if you take it out too early. And then, of course, if you wait a couple more years, you can get up to $2,400 if you waited to the age of 70, which is a 24% increase. Again, we're not playing God here. Who lives, who dies is beyond me. You guys have to figure that out the same way I do. All right. Again, we talked about in the other example of the pension, you may get a cost of living, but I can almost assure you for the most part in Social Security benefits, you can expect a cost of living. However, for those of you who work in organizations where you will qualify for Medicare, just keep in mind that the Medicare premiums most likely will balance out whatever COLA that you get, because Medicare premiums do go up annually. And we could talk about that in another video for another time, but just keep that in mind. So where do we go from here? You have some key factors to remember before we let you go: your work history, your full retirement age. The other thing I told you about not really rewarding high income earners in the Social Security workspace. You can see clearly here that as of 2024, those individuals who earned above 168,600 are not subject to Social Security taxes. So again, guys, this goes back to my point. If you made XYZ dollars of this amount or more, you're not even going to be counted in the aim. So it's going to be everything up to that dollar amount. So, again, you have to have other options for retirement savings. You have to have other options for your retirement savings. All right. So again, what are we looking at here? Is the income gap real? It's absolutely a real thing, and it is a thing. And hopefully tonight we can talk through some of the things that we can do about the gap. So the first thing we want to make sure we mention are the 4 quadrants of income loss. That's right, guys. 1, 2, 3, 4. And these are the things that we all have to be aware of before you sit down with your financial advisors and your retirement planners. Because if you don't look at these 4 quadrants of income loss, you're setting yourselves up for absolute failure. So what is the first one? The one that we all are very full aware of are the everyday daily expenses of life. Just the ordinary expenses that just don't go away because you decided to retire from the Florida state retirement system. They don't go away. They're there. So you have to keep in mind for those. You also have to keep in mind for the unexpected, right? You still have a house, you still drive a car, your car can go up, the roof can go up, anything can happen. The kids can call for an emergency, grandkid emergencies, best friend emergencies, you name it. So those are always going to be there. They don't go away just because you're retired. Sicknesses and long-term and short-terms definitely don't go away because you're retired. As a matter of fact, you can almost anticipate something happening. As we tend to get older, there are a lot of things that could creep in and cause us some discomfort. Now, again, I know what you guys are thinking. Depending on the type of health plans that you have with your employers, again, those who are looking at Medicare, as we talked about before, we have to understand that these plans, while very, very good, they do not cover every aspect of your health needs. So you have to take in consideration that there's still going to be income to deal with that as well. And of course, the dreaded loss of life and the income gap that's created when you lose someone of significance, a significant other, or partner in crime, or partner in joy that's helping you throughout your day-to-day operation. Well, so when that happens, And it's not a matter of if, it's when. You have to recognize that this can put a tremendous burden on your finances. So what are the solutions to the 4 quadrants of income loss? Yeah, the bucket system ideology. This is the solution to these problems. 2 of them you're well aware of already, Social Security and the FRS pension. But as we saw when we did the calculations, there's still some room for gaps. Like we saw, still some room for gaps. So how do we pick up the remainder of those gaps? You have your 403B, your 457s, your Roth IRAs. Those are the types of products that myself and my team, when we come out to meet you, these are some of the things that we're talking about. Again, you already understand the Social Security and the FRS aspect. So when we come out to talk to you at the district, this is what we're coming out to talk about. We're talking about the bucket here. And of course, last but not least, the Index Universal Life products, which absolutely are a game changer with the living benefit aspects, the chronic illnesses, and all those other unexpected expenses that these 2 buckets absolutely protect on the other side. So you say, well, what are they protecting? Well, let's explain it. You have your Social Security and your pension, which are basically compensating for your basic everyday expenses, the ones that are never going to go away. Okay, we got that. Now, what happens on the unexpected side, we have to be prepared for that. That is where the 403B, 457s come in. And of course, last but not least, those Index Universal Life benefits that come and absolutely join forces with the other bags of income. So this is where you now have the 4 quadrants of income loss covered, and there ends the retirement income gap that we all know is there. It's just that I hope tonight's video was able to bring that out in full force. Once again, guys, if you want to go into specifics about what other opportunities are out there, by all means, click on the link below. We'll talk soon. Appreciate your time and place. Ranji, AKA your console, the Network Nation. See you out there soon.